Aloha, inspired moneymaker. Thanks for joining us today. If this is your first time here, welcome. If you're a returning viewer or listener, welcome back. I want to start with a quote. Nothing is perfect. Life is messy. Relationships are complex. Outcomes are uncertain. People are irrational. That's a quote from Australian psychologist Hugh McCoy. And people like to think that they're rational, especially when it comes to money. But the truth, we're not. Investors make emotional, biased decisions all the time, often without even realizing it. Fear drives panic selling, greed fuels bubbles, and overconfidence leads to taking too much risk sometimes. Traditional finance assumes that markets are efficient and investors act logically, but behavioral finance tells us a different story. It reveals the predictable ways we deviate from rational thinking and helps us understand why. The efficient market theory may claim that stock prices reflect all available information, but it fails to account for human emotions. Remember irrational exuberance? So how do we make smarter financial decisions? By recognizing these biases, learning how they shape our choices, and using strategies to counteract them. In this episode, we're going to look at how to think and invest more rationally. Before we get started, this episode is brought to you by my financial advisory firm, Runnymede Capital Management. I want to invite you to take advantage of our 3-minute financial plan. Head over to inspiredmoney.fm/getplan. It just takes 3 minutes of your time, and you'll get a personalized snapshot to kickstart your financial planning journey. It's easy, it's quick, and planning goes a long way. So start your financial roadmap today. Give it a try, and I'm happy to set up a call with you to discuss your findings. Let's bring in our guest panelists. We've got a great group here. One more. We've got Colin Camerer. He's a pioneering behavioral economist and neuroeconomist known for integrating psychology and neuroscience into economic decision-making. As a Robert Kirby Professor of Behavioral Finance and Economics at Caltech, he researches neuroeconomics, behavioral game theory, decision science, and neuroscience of economic choices, earning him a MacArthur Fellowship in 2013 and an honorary doctorate from the Stockholm School of Economics in 2019. Colin, so glad to have you here.
Thanks for having me, and it's exciting to be on this wonderful panel.
I'm looking forward to it. And you're kind of a radical studying economics and the brain.
Yes. Caltech does a lot of things like that. So usually when we go to the provost or somebody for money, they'll say, who else is doing this? And if we say nobody, that's the best possible answer. And it's true in many areas like biomedical engineering, where people are putting together basic biology and trying to understand neuroprosthetics and lots of different things at Caltech. That's kind of our brand. Cutting edge
for sure. We also have Dr. C. Thomas Howard. He's a pioneer in behavioral finance, best known for founding or co-founding Athena Invest and authoring the influential book, Behavioral Portfolio Management. With over 35 years in academia and finance, he developed a groundbreaking approach that challenges traditional investment theory by focusing on how investors actually behave, revolutionizing portfolio management through a behavioral data-driven strategy. Tom, so good to have you here.
Yeah, I'm glad to be here. Thank you for inviting me, Andy. Look forward to talking about how we use behavioral finance for making the investment decisions in the portfolios we manage for advisors and clients.
And a shout out to LinkedIn, where I found you. We have Annika Echarti. You have to say your last name because I do not do it justice.
You did it great. Annika Echarti.
Annika Echarti. She's a recent CFP, a financial coach specializing in behavioral finance and financial psychology. With a background in accounting, law, and economics, she helps self-employed individuals and small business owners align their financial decisions with their goals and values, focusing on both practical strategies and the psychology behind money habits. Annika, glad that you could join us.
Thank you so much, Andy. Yes, actually, I got into behavioral finance and financial psychology because always when I talk to my clients, I found out that financial literacy is not just the one that makes us good with money.
And you teach a class at the UCLA Extension School?
Exactly. Yes, where we actually look into our own biases and see which examples we can come up and where we find that we have some kind of heuristics and biases during our normal day.
We're going to be talking a lot of biases today. And then welcoming back and rounding out our panel, we have Dr. Megan McCoy back on the show, PhD, licensed marriage and family therapist, accredited financial counselor, certified financial therapist, assistant professor at Kansas State University's Department of Personal Finance, Financial Planning. And she specializes in financial therapy, financial well-being, and the dynamics of couples' financial interactions. She's published extensively on these topics while also contributing as a board member of the Financial Therapy Association, and she's co-editor of the Financial Planning Review. Welcome back, Megan.
Thanks so much for having me again. I'm excited.
You always challenge me with all your accreditations.
I know
I can't fit it.
Sorry.
So I'm glad that you're here. I think that we have you for the next 30 minutes because you cannot stay for the whole thing. Half glass full. I'm delighted that you're here. Let's go straight into segment one.
Traditional finance assumes investors are rational, but in reality, emotions and cognitive biases often drive financial decisions. Behavioral finance explores why people make predictable mistakes in investing. Overconfidence leads to excessive risk-taking, while confirmation bias causes investors to seek information that supports their beliefs. Loss aversion makes losses feel more painful than equivalent gains, leading to poor sell decisions. Emotions like fear and greed also shape investment behavior. Fear can drive panic selling during downturns, while greed fuels speculative bubbles. Daniel Kahneman's System 1 and System 2 thinking further explain these patterns. System 1 drives quick, intuitive decisions, while System 2 engages in deliberate analysis. By understanding why rational investing is difficult, we can start to develop strategies to counteract these biases and improve long-term financial outcomes.
Colin, since you're at the cutting edge of neuroeconomics, how do cognitive biases manifest in our brains when investors make financial decisions?
Neuroeconomics is a vast thing and it's growing very fast. So even it's hard for someone like me who's at a good institution with brilliant grad students who are kind of my coaches to keep up. But I'll just talk about one study we did a few years ago and we're continuing to understand, which had to do with artificial price bubbles. And the advantage of that is it's hard to study price bubbles because a bubble is by definition when the price is persistently above some fundamental and then crashes. And we often don't know what the fundamental is for things like art and crypto and gold. But in the lab, we can create an artificial asset that pays a known amount of actual money. So people actually earn money based on what they do. And we can see if there's a bubble. And we get very reliable bubbles. But to your question, the most interesting pattern is when the bubble is growing, we see activity in a region of the brain called nucleus accumbens, which is responsible. It's a very old evolutionarily conserved area, which means lots of other mammals have activity there. And it's kind of a general reward center. So what happens is the people who are trading as the bubble's going up are having more activity in this region. In fact, it's really close to the term irrational exuberance you mentioned, which I think was coined by Bob Schiller and then used by Alan Greenspan. So that's kind of the fuel of the bubble. But meanwhile, there are other traders who, as the bubble is growing, start to have increased activity in a region called insular cortex, which isn't as well known outside of neuro, which is involved for essentially, it's part of the body's ambassadorship to the brain. It's an interoceptive area, which means it's the part of the brain that accounts for how our body is feeling. So things that are negative emotions like disgust and pain and financial uncertainty and anxiety will have activity there. So the traders who this is essentially like the fear area. So the nucleus accumbens is greed in the brain, and the insula is fear in the brain. And what causes the crash is when the fear-feeling traders start to sell a lot, and then eventually the crash occurs. So this idea of fear and greed, I would say there's a lot of other studies. These things are real, and they're actually in the brain, and we can see them.
Any insights into a novice trader's brain versus experienced? Because I think the experienced traders even have to deal with this.
Yeah, I think we haven't. There's an old study by Andy Lowe at MIT using 10 foreign exchange traders, and they were actually trading, with giant screens. And as many of you know, Forex for foreign exchange is a huge market. It's in terms of trading volume, it's really, I think it swamps the stock markets. And what he found was that he measured skin conductance activity, which is an all-purpose measure of a bodily reaction to arousal, whether it's good or bad arousal. And the experienced traders had much less activity. And we actually have seen that also in our data. So in these lab experiments, sometimes people will come a second time or a third time, and they're trading in the same way, but they've had the experience of having lived through a bubble and a crash before. And the traders who are more experienced have less of this skin conductance reaction. So that suggests that, even with a small amount of experience in our lab, like a few hours, or a lot of experience, like 10 years trading foreign exchange, that people can learn to kind of regulate their emotions or be less like surprised and go through less of a fear and greed cycle. So there's hope.
I like to hear that there's hope. Tom, your book, Behavioral Portfolio Management, argues that investors behave predictably irrationally. What's the most costly behavioral mistake that you see investors making repeatedly?
Myopic loss aversion is the most important. Of course, we all know about loss aversion. Losses are felt more strongly than gains are thought to be 2-to-1. And myopic, in that we have a hard time viewing things in the long term. And so anytime we run into, let's say, a stock goes down or your portfolio goes down or the market goes down, it triggers that particular emotion. And it feels like you have to do something. And this is driven by the fact that our brains are old, hungry, and impatient. They're old. It doesn't appear it's evolved in about 150,000 years ago. Think of the environment 150,000 years ago. We were surrounded by all kinds of dangers, saber-toothed tigers and so forth. And you had to respond to those. The brain is hungry. It consumes about 20% of the energy on a daily basis, but it's only 3% of the weight. And so we're impatient because, boy, back in those days, you couldn't stop and think and say, let's see, is that really a saber-toothed tiger or is rattling in the bushes? You had to take off. And so those basic emotions are there for everybody. And they bubble up all the time. And so unless you really think about it and work on it, they are the things that drive your decision. So it's myopic loss aversion that I think is the most important mistake that investors make.
Megan, what are your thoughts? I mean, it definitely seems to go back to like primal urges, right? Fear and greed. Do you also look at how financial traumas influence our investment behaviors?
Oh, absolutely. I think the experiences we have with our own investments, as well as observing our parents or other loved ones in our lives have their firsthand, almost like a vicarious assumption of anxiety can happen. And I think there's some interesting gender dynamics that are coming out around loss aversion and confidence, especially around risk tolerance. We just did an interesting study where we found that men were higher likelihood of experiencing financial stress, which led to moving out of the market when they shouldn't have. And they also were more likely to experience overconfidence in their decision-making around investments, which also led them to make the decision to leave the market when maybe it would have been better to just sustain over time in their current position. So it's fascinating to see the combination of lived experiences, gender dynamics, and even previous experiences in your family can shape your investment decisions.
Guys, overconfident? Never. What about just money and emotions being so deeply intertwined? Do we need to separate one from the other?
Oh, I love that for people. I would love to take the meaning of money and the meaning of investment decisions out of the equation, but I don't think that's possible for us. I think we are guided by a host of cognitive biases that influence our decision making that are completely tied to our emotional stability, our emotional how we're feeling in that moment in decision. So I think it's impossible to do, so it'd be better to become more self-aware of what emotions are impacting your decisions so you can separate it and make a more logical choice.
Annika, how important is it to align our financial decisions with our values?
Extremely important. And I like to make the distinction between financial literacy, behavioral economics or behavioral finance, and financial psychology, knowing how each one has a play and each one contributes to how we interact with money. And knowing your values is very, very important to then go against biases we have, or to then go against emotions that are very strongly tied to our feeling towards money, which come from how we grew up, which surroundings in terms of what was the economical shape, or the economic, what did the economy look like at that point, and what kind of family did I grow up? How was money talked about? All these kind of things. When we know our values, we can then try to overcome these things and really stick to what we believe in and how we want to spend our money.
Anyone else on this segment 1, Foundations of Behavioral Finance? Okay, let's go to segment 2.
Cognitive biases influence investment decisions, often leading to costly mistakes. Loss aversion causes investors to hold on to declining assets rather than accept a loss, even when better opportunities exist. Recency bias leads people to overemphasize recent events, making them reactive instead of strategic. Herd mentality drives market bubbles and crashes as investors follow the crowd instead of independent analysis. Other common pitfalls include home bias, favoring familiar investments over better global opportunities, and anchoring, where investors fixate on past prices rather than current fundamentals. These biases distort rational decision-making and increase risk exposure. To mitigate these biases, investors can implement disciplined strategies such as predefined exit plans, systematic investing, and portfolio diversification. Awareness is the first step in avoiding these traps. By recognizing and addressing these biases, investors can reduce errors and make more informed financial choices.
Megan, I want to start with you. Financial therapy emphasizes self-awareness in financial decision-making. How can investors develop emotional intelligence to recognize these biases?
Oh, I love it. There's this beautiful book called Facilitating Financial Health that kind of describes different exercises you can do to kind of unpack the early emotions that may make you more predestined to make choices that are based on your emotions rather. One of them is a money egg, where you kind of draw out all the early memories you have around money, whether it's giving, receiving, earning, losing, spending, buying, whatever it is, and kind of create a storyline about all these experiences throughout your life and how they shape your relationship with money and impact things like your risk tolerance and your investment, aggressiveness. So I think doing that little look backwards can help you move forward in a better way.
Tom, you mentioned loss aversion in the previous segment. Like, what's an effective strategy to help investors recognize when it's time to cut a loss?
The best way to do it is have predetermined selling rules. And let's start at the very beginning with working with an individual and how can we get them to make better decisions. The start of this, we believe, is planning. Working with a financial advisor, we think, is very important. So you develop a plan, and then you decide what their needs are, and then you fund each of the needs separately. So you've got liquidity needs. So you fund that with low risk bank accounts or money market funds. If you've got income needs, you head towards retirement, you lock those down for several years. And then the rest of it is a growth portfolio. So we call that, and it's very popular, bucket approach to doing things. Once you do that, then you can look at each of those separately. So when the stock market is going down, that's part of your growth portfolio. It's not part of your liquidity portfolio or your income portfolio. As an investor, and we are professional investors, we developed rules-based investing approaches. So we do a considerable amount of research on this, and we say, these are the particular behavioral factors that we think are measurable and persistent. We use those for making our decisions. We then develop selling rules. And so it's not watching, and in many of our portfolios, we don't even watch what the stock is doing because that's an emotional trigger. We have other triggers that say, tell us when to sell that stock and when to buy it. So that's important to develop those very disciplined rules-based investing, and also for the selling. So before you even buy the stock or whatever, you decide what is the criteria I'm going to use for selling them.
Colin, your thoughts?
Yeah, I think what Tom said about myopic loss aversion is so profound. And so there's two parts to it, right? Which is a natural aversion to loss relative to equal size gain. That's been well established in many, many domains, not just in little lab experiments, but in studies of labor supply and marathon running. People react differently to running a 4-hour marathon compared to 4:01. But the second part of it is the myopia, right? So in other words, if you could say to yourself, well, the stock market went down 5% this month, but these other good things happened to me, I'm going to kind of emotionally cancel out or sort of emotionally launder that loss against some other good thing, then that would do a lot of work. And the buckets approach is kind of one way to do that. I think it takes a certain amount of just emotional regulation. I think something some of the rest of you will know a lot more about might have to do also with household dynamics. So my wife, for example, grew up in a very low income child of immigrants and is very, very much of a tightwad. So as we started to accumulate some wealth, I had to kind of train her to enjoy spending money on things like vacations that we could well afford. And it really was a kind of household financial therapy. And I think she's much happier and I'm much happier, and, we're enjoying life. She has a high paying job. We're enjoying life. We're using the money to generate happiness, right? Not just some kind of dynastic nest egg.
Yeah, go ahead, Annika.
Thank you, Andy. Yes, actually, too, I want to add to what Tom said. I totally agree. We know that many investors know that long-term investing is better than panic selling, and they still do it. And investors understand the importance of diversification, and they know about loss aversion. However, when it comes to really working on it, I just found out myself when I was teaching a class, and we had presentations, and the presenters mentioned a stock, and that if you have that one in your portfolio, you should have sold it already like ages ago because it's not coming back. And I was sitting there and thinking, actually, I'm the one who has this stock in the portfolio. And even though I know that it's not coming back and I shouldn't be holding on to it because I have a high opportunity cost there in just investing the rest that I have into a better performing stock, since I did not talk to anyone before and I did not make the plan before, and I'm still just hoping. I have been holding on to it. And I'm a big fan of do-it-yourself investing, but be sure that you make a plan beforehand and maybe implement a savings plan, not look at the stocks. If you are looking at, zoom out, even though one of them might be performing badly, others might be doing great. And so it's fine to just, cut your losses and invest into a better performing portfolio. And if you cannot do that, it's really helpful to get someone like a financial advisor, financial coach, to be on your side and to be your sounding board, and also to help you just go through with it in a more objective way.
Megan, I want to go to you before you have to leave.
Yes, I just want to echo what Annika shared. I think one of my favorite quotes about stock of all time was when Warren Buffett was asked after the 2008 crash, how much money did you lose during the Great Recession? And he said none. He had made a plan and had diverse stocks and had a long-term time horizon that allowed him to weather the storm. And so I hope listeners and investors find ways to create a plan and controls to keep the emotions out of those investment decisions and play the long game instead.
Thank you so much. It pays to be Warren Buffett.
It does help.
The experience, and also he gets access to some very good, attractive deals. Let's go to the next segment.
Investors often rely on intuition, but structured decision-making frameworks can improve rationality and reduce costly mistakes. Prospect theory explains how loss aversion influences risk-taking, causing hesitation in seizing good opportunities and reluctance to exit poor investments. Reframing losses as part of a long-term strategy can help overcome this bias. Bounded rationality suggests that investors make decisions with incomplete information, often settling for good enough choices rather than optimal ones. Decision support tools such as investment checklists and systematic strategies can improve clarity. Mental shortcuts or heuristics simplify complex decisions, but often lead to errors. Availability bias causes investors to overweight recent news, while representativeness bias leads to false pattern recognition. Techniques like pre-mortem analysis, anticipating worst-case scenarios, help investors prepare for uncertainty. By adopting structured frameworks, investors can make more disciplined, objective financial decisions.
Colin, the headlines these days grab a lot of attention and have an impact on financial markets. What are some effective strategies to improve decision-making under uncertainty?
Well, first of all, stop doom scrolling, which I often do. I think a couple of people mentioned taking a long view. So I think we have Danny Kahneman used to say, nothing is as important in the long run as it feels like in the moment. So no matter what dramatic thing some dramatic thing will happen today in politics, or maybe tariffs, or the markets, or GDP adjustment, a year from now, it will just be a blip on a chart. And I don't know what therapeutically the right way to get people to think that way. I do think, by the way, aging helps in the sense that the peak for most of our sensory motor things like hearing and hand-eye coordination is around 25 years old. So when you get to be 65, which I am, all those things are degraded. But one good thing, the silver lining, is that in general, people get better at emotional regulation, at not letting small things bother them. And so I don't know how that works as advice, but it just means if you're an anxious person in your 20s and 30s, decades later, you might be less anxious about money. And I just want to echo what everyone said about having a plan. If you have a sort of, a plan for what happens if something goes down by 10% and you're kind of prepared to sell it, then in terms of reference points and psychological dynamics, it might be a lot easier to actually execute that sale.
Yeah, it helps to have a long-term approach. It helps to think about taking your time, and then also maybe thinking about your 50, 60, or 70-year-old self to make more balanced decisions. Annika, do you have stories of helping clients to shift from making an emotional decision to having a more systematic approach and a better planned approach?
Yes, that's what we generally do, to make a plan in the beginning, to talk about and evaluate their risk the risk tolerance and decide together on the portfolio they can invest in, but also to make a plan what happens. But I would like to echo also what Colin just said. So there have been studies on the effects of news on investments, and one of them, I remember there were two groups, and one received news and the other did not. And the group that received the news, that did not receive the news, they outperformed. And the explanation here is actually that investors often feel the need to react when they receive news, and oftentimes they are completely irrelevant to the long-term performance. So when we talk about this with clients, it is, again, what Colin just said: stop doom scrolling, stop listening to the news. They are often writing something to sell a story and not actually to help you. So that's something which we discuss, but oftentimes people call when the market tanks and to ask, what should I do? And that's when we're talking, be like, look, zoom out and see what the market has been doing over the past 50 years. And there are always small dips. It's not a linear way up. Look at the small dips. That's one of them. We're just in it, and we hang in there and we keep on going.
Tom, tell us what you've learned working with both advisors and clients to keep them on track.
Yeah, that's really a challenge. The advisors, our best advisors, are one, again, that developed a plan, did use the bucket approach, so that the only part that where volatility has an impact is in their long-term portfolio, and by and large, you should ignore that. I always like the expression, what goes down must go up. And if you look at the history of the stock market, that's been the case. The average drawdown in the stock market on an annual basis, max drawdown, is 14%. But over that same period of time, the stock market generated a 12% annual return, which says if you paid attention to the drawdowns and did something, you missed that opportunity for a 12% return. So yes, I think the others have mentioned, let's quit listening to the news. The way I like to say it is, when we manage portfolios, I'm from Denver, and I've always liked the Denver Broncos. So I read every story I can about the Denver Broncos, but I never use any of that information for making my investment decisions. And that's the case I use for almost everything else. I'm a background economist, love economics. I read everything I can, but I have a very disciplined approach to managing money, and the things that are important to keep track of. The rest I read about, it's interesting, but I don't use it for making the investment decisions.
Colin, can you comment on mental shortcuts or heuristics? And what are the most common heuristics that investors use, and how can they avoid being misled by them?
I think one that's, well, you reeled off a whole bunch. Confirmation bias and overconfidence are important when you're thinking about either the entire market or your whole portfolio, or say individual stocks or individual housing. Taking a long view is not hard. And I should add, I don't work with clients and so forth. I'm just a professor in the ivory tower. But there's more and more technological tools to help you discipline your mind and to sort of shape the information that gets in front of you than ever before. So if you go through a certain amount of therapy or work with an advisor and think, okay, I want to be more disciplined about my money, I want to create buckets and so on, there's a million ways to actually do it without having to have like jars in your house, that have cash in it for the rent and cash for movies like 70 years ago. Let me say one other thing, which is, I think one of the most pernicious cognitive biases, it's so built into human memory, it's hard to even call it a bias. It's just a natural way that our memory works, is hindsight bias, which means after something occurs, our recollection of what we thought about it is biased in the direction of what happened. There's a zillion studies on this. It's really robust statistically. It's one of the strongest things. And that also fuels regret and if you could expunge hindsight bias, like with a pill or electrical stimulation to the brain, it would be great, because hindsight bias does almost no good. And it creates this illusion of predictability, and it fuels regret. So if you can kind of discipline yourself to, there may be tools that could actually do it. For example, you keep track of like what you think is going to happen about certain important events. Is there going to be is my house going to go up in value? Is there going to be a crash in the stock market? And then you go back and look at those. That might be a kind of cure for hindsight bias. And the reason I mention this again is that it's a really irresistible thing. It's just how our memory works. We kind of partially overwrite what we thought before, and we replace what actually happened with what we remember having thought would happen. And it generates all kinds of regret and things like over-testing and medical over-testing, because if the doctor makes a mistake, you think they should have known better, even if they shouldn't have. And it has all kinds of ramifications.
Annika, I see you nodding.
Yes, especially the hindsight bias and that it fuels regret. I know it personally, but that's something we talk with clients a lot. And obviously with clients, I don't go the academic route there. Normally it's like approach it with kindness towards yourself. And since you are now in this situation, we are talking about things, you are thinking things through, you try to make the best decisions right now. Trust that you did that also in the past, and know yourself well enough that if you had known better, you would have taken, or if you would have known differently, it doesn't even have to be known better. If you would have known differently, you would have taken different choices. So trust yourself that you took the best choices with the information you had at that point. To not constantly regret. Otherwise, we are always living in the past, regretting which decisions we've taken.
Especially with money.
Yes. And it goes in both ways, right? It's why did I not invest into XYZ? Or why did I not invest more into XYZ? Because now I know it's gone through the roof. And either way, you should be fine with what you did and adjust when you know differently, I want to say.
Thank you. Let's go to segment 4.
Social forces and media narratives strongly influence investment decisions, often driving irrational market movements. Herding behavior occurs when investors follow the crowd, leading to inflated asset prices or panic-driven sell-offs. The GameStop rally of 2021 showcased this phenomenon as retail investors coordinated through social media to push prices beyond fundamental value. FOMO, or fear of missing out, further fuels impulsive investing, as hype-driven markets create pressure to chase trends. Media amplification of market movements can distort investor perception, making short-term fluctuations seem more important than they really are. Contrarian investing challenges this dynamic by prioritizing independent research and long-term fundamentals over collective sentiment. Strategies for resisting herd mentality include reducing social media exposure, setting clear investment goals, and maintaining a disciplined, diversified portfolio. Understanding the role of social influence helps investors stay focused on rational, data-driven decision-making.
Colin, this segment plays into what you were talking about earlier with bubbles and irrational exuberance and how it plays out in our brain.
Yeah, I think this is an incredibly interesting topic. And I will say also that in Bob Schiller, in his books and writing about irrational exuberance, talked a lot early on, I think in the late 90s, about the importance of social forces. Like when the stock market's going up, people are talking about it at work. They're comparing notes, said, are you invested? Oh, my neighbor bought Apple and it went up 100%. And so there's a big social influence effect. But in academic finance, at least in the high profile journals, it was completely neglected. Right? The models don't have any herd behavior in it. But David Hirschleifer, who's a neighbor, Southern California neighbor at USC, has been championing the role of social forces. And so now it's an actively studied academic topic. So that's good news. And I think that it goes back to some things that Dr. Howard was talking about, which is herd behavior is part of our normal healthy functioning, to be sensitive to what other people are doing, either because it may give us information about what the right thing is to do, or there's safety in numbers or something of that. So it's very hard to resist. I think the advice of consume a little social media, or do like Tom mentioned, which is read about the Broncos all you want, but don't gamble, right? Or don't put your money on the line. It's a good idea. And the other thing is to, even though we have this explosion of social media and information diet, but you can also curate your information diet quite reasonably. So figure out what your herd is, or what group of people you think identify with you and think like you about the long run and the short run and alternative assets, or whatever it is that's central to your financial thinking, and make that your herd. And then at least you're a little bit immunized by others. And final thought, which is one of my favorite Warren Buffett sayings, is, when people are greedy, be afraid. And when people are afraid, be greedy. And essentially what he meant was, try to be in a kind of emotional contrarian. And of course, not everybody can do that. And it's hard. You almost have to shut off the natural instinct and all this neural circuitry that says a lot of people are doing something. Why am I not doing it? But I think in the therapeutics, you could kind of distinguish between, am I doing this just because other people are, or for some other reason? And hope that maybe asking that question in a disciplined way, or thinking it through with a financial advisor or even a spouse, could be helpful.
I often say that there's only one Warren Buffett for a reason. Mm-hmm. He's willing to make those contrarian decisions when it's very hard to do so. Annika, how do you help clients make those independent financial choices rather than following what everybody else is doing?
Curbing their overconfidence. Exactly what you just said. There's just one Warren Buffett for a reason. And on social media, I see it so often. It's we are motivated to listen what Warren Buffett is doing and how he approaches things. And I think we are basically told that we should do the same, but no, we are most likely not as special. So just stick to the market return and invest into a diversified portfolio and stay out of it, because it shows over and over again. If we look at the statistics, the market returns on average, the S&P 500 somewhere between like 9.69%, something like that. Mm-hmm. And if you look into the individual investor gets an average of 3.5% or something like that. So just stick to the market and don't try to outperform it, because you will be unsuccessful, most likely.
Tom, in 35 plus years experience in academia and money management, do you have any stories to share of falling victim to the herd mentality or successfully steering clear of it?
Generally, I've steered clear of it. I'm kind of an odd duck in that regard. Let me respond to Annika, what she was talking about. The reason individual investors underperform the market is myopic loss aversion. They tend to sell when the market has gone down and don't get back at the right time. Mm-hmm. So there is an argument for staying in the index portfolio for that reason and never looking around. But there's tremendous opportunities to earn exceptional returns, which we have done and others have done in active management. And again, it's got to be a disciplined approach. You've got to do careful research and decide what you want to invest in. And then the sell decision, again, has got to be automated. Another thing we see, and this is really frustrating as a professional manager, but you think the professionals should be better than the individuals in this regard. But they're no better. So we go out, we have a rather unusual set of products. So we go out and talk to potential investors. And one of the first questions they ask is, so who else is invested in this? And I go, okay. And for example, in hedge funds, for years, hedge funds The people, when they make investment decisions, they put their money in their largest hedge funds. Well, the research showed that the smaller hedge funds, and that's true in the area in which we operate, outperform. They do better. But, you don't have as many investors as the big people do. So there must be something wrong there. Why are not so many people in your fund, and there's millions in these other funds? So that herd mentality plays an incredibly important role in professional management as well.
Huge. Yeah, herd mentality
Can I
and
ask
risk
a
aversion.
question?
People don't want to take a risk.
Tom, why do you think that the smaller hedge funds perform better than the big ones? Do you have any data on that, or any guesses?
There's three things that cause. We always say behavior is more predictive than past performance, and the behavior of a fund that's successful, a narrowly defined strategy. We don't want specialists. We don't want generalists. We want specialists. A narrowly defined strategy pursued consistently in taking high conviction positions. So in other words, you want to be different than your underlying benchmark or your index. Those three things, those three particular behaviors are predictive of better performance. What happens, of course, when you're an active equity manager like we are, is you always have periods of underperformance. That's just the nature of the animal. And what do investors do? Myopic, loss aversion, or performance chasing. They sell you and they buy the one that has outperformed. That's a recency bias problem that's outperformed. And so there's a strong incentive among particularly mutual funds and hedge funds too, to become closet indexers. So if I am successful and I've attracted investors, I then turn into a closet indexer so I can't underperform so people won't leave me. And that is a huge problem in the industry. And the reason that the active universe has on average underperformed the indexes is because of closet indexing. The vast majority of what so-called active funds are really closet indexers. So those are the dynamics of the industry.
Yeah, I was going to just add, I think there's some evidence from sports betting about this principle of specialization, not generalization. So I used to bet on horse racing a lot, not pathologically most of the time, and not successfully most of the time, because the house has a 50% advantage against you. And when you read about professional gamblers, a lot of them have exactly this strategy. So there's somebody who says, I'm just going to study turf racing at Santa Anita and other Southern California tracks, and I'm only going to study 2-year-old fillies, and which are young female horses, and know everything there is to know about that. There's one bettor who would go out in the morning and he would walk around the track and kind of get a feeling literally for the soil and blah blah blah. And there you might have a chance, right? Because most people at the track are not going to be so hyper specialized in a particular type of racing, right? They're kind of reading this Wall Street Journal. And the other thing investors do is about conviction is don't make every bet. The wise sports bettors might bet, there's 24 NFL games on Sunday, and they might bet one game, or they might bet once a month. But figure out when you think you have a really big edge. And to the point about small hedge funds and large, the large hedge funds, in a sense, kind of have to be constantly betting, right? Whereas the small hedge funds have the luxury of being able to be more focused on an asset class or an emerging market or something where they think they can really learn a lot that isn't priced in.
Yeah, and I'll add to that, in business, there's economies of scale where size helps you. But sometimes when you're managing money, if your assets become too large, it becomes harder to find investments where you can actually generate alpha. When you're smaller, you're just more nimble. Right.
Exactly.
And you can take bigger bets and take quicker bets.
But the problem is you're small, so why don't you have more people there? So it's the challenge. Right.
The gatekeepers won't they won't allocate you money because it's too much risk for them to stick out their neck. They all want to bet on the same horses, so to speak.
Yeah. It's professional risk.
Exactly. If I may take a small tangent, I've been getting a lot of calls from clients this week about tariffs and the impact on the market. And I just wanted to ask the economists in the room, can you walk us through how expectations about tariffs might impact market outcomes and how investors may incorporate these insights into their strategies?
So there's no economic argument for tariffs. They make absolutely no sense from an economic standpoint. And David Ricardo did that 200 years ago. And so economics and economists can't argue for tariffs at all. Of course, Trump, the way he's doing it, he's playing a bit of a game. He says, I'm going to threaten you tariffs, and then I want you to lower your tariffs. So predicting it, it's more like, what's Trump going to do? Is he going to actually go forward with the tariffs or not? And so that's really what you got to predict. And there's really no way of knowing what that is.
Yeah. I totally agree with Tom. It drives me crazy when there are headlines that politician suggests tariffs may be good. Some economists disagree. No economists disagree. All economists disagree. It's a deeply well worked out thing that goes back ages in the discipline to Ricardo, as Dr. Howard said. And the other thing that's kind of good news, if you think tariffs are bad and we'd like to see them unwound, is the impact happens very quickly. So first of all, markets really look ahead, right? So as soon as, you could actually see on media during one speech, you could actually see in the corner, the stock market was falling a little bit from like minus 0.9%, minus 1.06% as the president was talking. So the markets are really looking ahead. The markets are, know a lot about tariffs. People understand the macro implications. And the other thing is the price changes may happen extremely quickly, right? Because the tariffs are paid by the importers and they typically want to pass them through 100%. They'd rather not have tariffs, but if they do, they want to pass them through to customers because there's no slack in the price to absorb it. So the negative impact of tariffs, I think we may see very quickly because the stock market's essentially a forecaster, and you could also see that in various segments, right? So some segment that's going to be hard hit by tariffs, which might be housing starts. You're going to see housing stocks might fall if we can't import lumber from Canada and what have you.
Yep.
So there's a kind of early warning system that's available about the likely negative impact of tariffs.
Any insights from your game theory research? If it's just being used as it's a chip, right? The threat of tariffs.
I think Trump fundamentally doesn't understand the economics of tariffs, that it's a tax. He thinks it's a tax on China or on Mexico. I think he just doesn't.
So that's a danger. That's a danger to the market and to investors.
It certainly is.
To the world, yeah. And in his first, I don't want to get too deeply into the politics. We all have our own views, but in his first term, he was also restrained on a lot of these things by others. He had the same ideas about tariffs, but people were advising him who just knew more. He had better economists working with him, saying no, and now there's just much less restraint. So it goes right from his social media feed into policy.
Am I correct? Go ahead.
Yeah, let me respond to that too. I had lunch with friends the other day, and one guy kept saying, Trump certainly has some smart people around him, and he'll talk them out of this. Well, the evidence is now the other way. It looks like everybody around him believes the same thing he does. And my poor wife, we sit and watch the news, and I say, yes, this is so terrible. I can't believe they're doing this. And everybody around him spouts the same thing. And some of the anchors on the news channels spout the same thing. And I'm going, what is going on here?
Am I correct to assume that tariffs make even less sense? I mean, they did not work in the 1930s, but today, because we have globalization, we have outsourcing to lower cost countries, right, from developed countries? Does it make less sense even today?
Yeah, I think so. It's also very difficult to actually administer them, because if you build a car in Canada versus in Mexico versus the US, a lot of the parts came from Japan or from China or from Finland, and it's hard to even know, what it means to tariff the country that's originating all the parts. And there's also a lot of workarounds, right? So there's a lot of what used to be made in China, like garments, is now made in Indonesia, Vietnam, even Cambodia. So there's lots of places. If you place tariffs on China, the Chinese will just go and set up plants in Cambodia. So there's a kind of a game of whack-a-mole. And you're absolutely right, I think, Andy, because the globalization is so thorough. There's such a network. It's even hard to know, what a tariff effect would actually have, and would it even persist, and so on. It's just it's never been a good idea. It was not a good idea then. It's an even worse idea now.
Exactly, and they talk about local content. What a joke that is.
Right. Mm-hmm.
If you follow the supply chain on a car, there's tens of thousands of parts, and they come from all over. And sometimes they go into the United States and then out of the United States and then to Vietnam and back from Vietnam. It's just a silly game.
Sorry.
Go ahead.
Sorry. And people think that it helps the local producers to sell more products, and that these products stay cheap in comparison to the tariffs. But I've seen it in Brazil, where I lived for half a year, that actually the prices of the locally produced goods go up just underneath of what what the products that are imported cost. So in the end, the people have then the choice oftentimes between a product that has worse quality, is just a little bit cheaper than something that has been imported with, probably a little bit better quality, because it has, all the parts from all over the world, and the input from there.
So I taught international finance for years, and I used to say, international trade, it's widespread gain and focused pain. And Trump is responding to the focused pain. And so the widespread gain, that is diminished by doing tariffs. And I used to say to my class, and I had a lot of Chinese students in my class, and I used to say to the American students, have you ever written a thank you note to China when you went to Walmart and looked at it, it was made in China and it's really inexpensive? And they all went, oh, I would never do that.
Good point. Yeah, there are American retailers who have had very large margins, very profitable, because they've been able to buy cheaper products overseas. Thank you for indulging my questions and answering them. Let's wrap it up and go to the last segment.
Understanding behavioral biases is one thing. Overcoming them is another. Many investors struggle with impulsive decisions, panic selling, and chasing trends, all of which can derail long-term financial goals. The key to smarter investing is creating systems that reduce emotional influence and encourage rational decision-making. One effective strategy is automation, using tools like dollar-cost averaging and robo-advisors to remove human error from the equation. Setting clear investment rules, such as predefined entry and exit points, helps maintain discipline. Regular portfolio reviews ensure that decisions align with long-term goals rather than short-term emotions. Another powerful approach is mindfulness, acknowledging emotional triggers before acting on them. Keeping a decision journal, seeking diverse perspectives, and practicing patience can improve investment choices. By focusing on strategy over instinct, investors can build resilience, minimize costly mistakes, and stay on track for financial success.
Tom, we talked a little bit about some of the tools and technology available today that can help us. Do you see automation tools like robo-advisors as a way for investors to kind of reel in their emotions and do a better job execution-wise?
Actually, I don't. I think you need to have an advisor. I mean, the robo-advisors play their role and they can automate some of the process, but the most important thing is the behavioral coaching. So to avoid those emotional mistakes, you need to set up kind of this whole series of barriers. One is put together a financial plan. Two, decide what you need in each of your buckets, the liquidity, the income, and the growth. The growth portfolio is your long-term portfolio, and you shouldn't be responding to short-term events in that particular portfolio. And then from a financial advisor standpoint, it's the counseling. It's a behavioral counseling. And we work with lots of advisors. We have some really very good advisors. And it's predictable when their clients are going to start calling them. In fact, our best advisors have done such a good job that when the market crashes, their advisors haven't called them because they know what the advisor is going to say, and they believe their advisors. And then on the investment side, as we've talked about, strategy, consistency, conviction are the key behaviors for superior performance. And then very disciplined rules for making investment decisions, particularly in the selling decision, where what is the criteria, and regardless of what's happening, if it triggers that particular signal, then you go ahead and sell. So those are you basically protect yourself from your emotions and building it out that particular way.
Right, rules-based decisions.
Yes.
Annika, mindfulness and self-awareness play a role in better decision-making and financial decision-making. Any practical exercises that you recommend to people especially if they're struggling with emotional biases?
Yeah. Take a deep breath and remove yourself from the situation, especially if people feel physical or feel their emotions physically. Step back, go out for a walk, well, obviously meditate or something like that, but I feel that oftentimes it's not very practical during the day. But breathe slowly. And apart from the mindfulness there and writing, for example, a journal and those kind of things, I do say that, but I'm personally not the person to sit down and meditate during the day and write everything down in a journal. I really think, and that's what Tom has said and also Colin has said, that's where the advisor comes in. That's where the coach comes in. And that's the beauty of our job, I think, also. When people talk about AI and everything taken over, AI can tell you the same things, but it cannot really hold your hand so far. And really having a trusted person that coaches you through and stands by your side, I think that is an absolute game changer.
Colin, neurological research shows that habits shape behavior over time. How can investors rewire their brains to adopt better financial habits?
Oh, that's a great question. And actually, it's almost as if you read my mind. I can end on a point I think I wanted to make that hasn't quite been brought up, which is one of the most basic principles of good personal financial planning is to start investing early and take advantage of compounding. So for biological reasons that I think are pretty deep-seated and old and have to do with evolutionary mismatch, if people just do not appreciate the power of compounding. It's amazing. It's like we have this linear model of how things grow, and it doesn't capture all the takeoff of exponential discounting. So the solution is very simple, which is start investing a small amount of money early on a regular basis. If you're not well paid, take out $10 a month. If you're better paid, take out 50 or 250, and just set it and forget it. I mean, it's a really simple thing to do as long as you can, afford that little bit of savings. And of course, lots of employers will kind of do that for you through 401k. But you can start to do this when you're with my son. We started when he was 8 years old, I think, as well as setting up his college fund, which is tax advantaged. Let me end with a story about this, which is a good friend of mine, Keith Weigelt, who's a professor at Wharton Business School, for about 10 or 20 years has been teaching lower SES families in West Philadelphia about basic financial planning, having a bank account, avoiding overdrafts. A lot of them don't have bank accounts, and the consumer banking is expensive if you don't have a certain minimum balance and so on. And he told me recently that he's working with the Sean Carter Foundation, that's Jay-Z, to support financial literacy teaching in HBCUs, and essentially expanding his scope from Philadelphia to lots of other places where people need extremely basic personal finance advice. And he mentioned the following, which was mind-blowing to me, which was a lot of his clients have kids who enter the juvenile justice system for one reason or another. So they may be a 15-year-old kid who's going to spend 2 years in juvenile detention, and some of them are in prison. And it's ironic as can be, but the advantage of prison is you can't waste money, right? So if what the prisoners are doing when they're in there at age 16 or 18 or 19 is for 5 years, somebody is investing money on their behalf, right? They're not going to take the money out and squander it, right? It's just going to grow and grow and grow. And so in a way, even though being incarcerated is horrible, it gives them this protection from the temptation of grabbing their money out of the bank. So I think that's just an example of a particular draconian automation. But saving a little bit of money early is such a simple thing to do. And there are lots of fintech companies that are working on this. Most commercial entities would love to open, bank accounts for kids with a parent signing at almost any age, and just watch it grow. So he spends a lot of his time just showing people compounding charts and asking them to guess, how long do you think it will be before this doubles? Or 20 years from now, how much will it be? Just kind of pounding in, like, compounding is your friend, compounding is your friend. It's a simple lesson. It's 101. But somehow it's just getting you to appreciate the power of compounding. It's just a pedagogical thing. And it's so low cost and good for people.
Huge one. As they say, compounding's the eighth wonder of the world. And there are some policymakers who are advocating for forcing citizens to invest a portion of their salary so that it's not a 401k and optional, and you don't have an employer providing the plan. It's what if the government made you and forced everybody to invest regularly into an account, and then through compounding, it's really significant over time. Annika, you had something to say?
Yes, exactly. So it is obviously the compounding, but as Colin has said before, the more seasoned an investor is, the less emotionally attached this investor is. So if you also start early and with small amounts of money, not having as much on at stake, it teaches you to detach emotionally from your investments and to become a better investor.
Yep. Investing early and often is a great habit to develop, and it pays you handsomely. Any closing thought, anyone?
Yeah, so somebody, I had a lot of undergraduate students come in and talk to me, and my recommendation was that when they get their job, take 10% of their salary and put it into a self-directed IRA. And invested in SSO, which is the double levered Standard & Poor's 500, and never look at it. And when you reach 40 or 50 years old, you'll be a millionaire. And it's just incredible if you look at it. Again, that's compounding on steroids because it's levered. And it just generates tremendous wealth. People have the hardest time, of course, staying with that, not looking at it. But if you did that, you'd do very well.
I think that's a great place to close. It's been a fascinating discussion. If there's one thing that I took away from this conversation, it's that we're all wired to make bad decisions and bad financial decisions. but recognizing our biases is the first step to making better decisions. And whether it's FOMO pushing us into a frothy stock or loss aversion that keeps us stuck in a losing investment, our brains can be our own worst enemy when it comes to money. But the good news is that we can outsmart ourselves. So thank you to our panelists, Colin, Tom, Annika, Megan, for sharing valuable insights and strategies to help us overcome these biases. And one that really stuck with me is having a decision-making framework in place, having a plan, so that it's not just your emotions kicking in, that you have an exit plan for a stock or an investment, so that decisions can be made when you're calm and that you can stick to that plan. In my work, we look at financial markets using an METV discipline, which stands for Monetary, Economic, Technical, and Value. It's a diffusion index of over 40 variables that helps us to evaluate and make decisions about where we are in the market cycle. And it allows us to be methodical and avoid making impulsive decisions. So if I may give an assignment to all our viewers and listeners, here's what I want you to do. The next time you're about to make an investment decision, pause, as Annika said. Ask yourself, is this a decision based on a solid strategy, or is it driven by emotion? And write down your reasoning before taking action. And even just becoming aware of your thought process can help you to make smarter decisions and smarter choices. Let's start investing more intentionally and less emotionally. And let me know in the comments what's one bias that you've noticed in your own financial decisions. If you found this valuable, please share it with someone who would benefit by sharpening their investment skills. And don't forget to subscribe so you never miss an episode of Inspired Money. A shout out to the Inspired Money Small But Mighty team. Excellent segment edits by Bradley, our producer, and graphic animations by Chad Lawrence. A big thank you to all of our panelists. Be sure to follow them. Colin Camerer, Robert Kirby, Professor of Behavioral Finance and Economics at Caltech. You can find him at, I think it's hss.caltech.edu, which is the Division of Humanities and Social Sciences. You can find Tom Howard at athenainvest.com. Check out his books. One is Behavioral Portfolio Management. You can find Annika Echarti at echarti.finance. And Dr. Megan McCoy, who had to leave earlier, you can find her at hhs.k-state.edu. That's the Kansas State University website. Thank you, everyone, for joining us. The next Inspired Money episode will be Retirement Income Strategies, Maximizing Returns for Financial Freedom. We'll be back next week. Until next time, do something that scares you, because that's where the magic happens. Thanks, everyone.
Thanks for having me.